So it's going beyond law in a level of detail that is required by businesses which are doing global trade, which involves sometimes thousands, if not millions, dollars contracts.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
Welcome to Trade Treasury Payments. My name is Deepesh Patel, editor at TTP. Today, we're having a bit of a breakfast in Singapore. I'm delighted to be joined by Tomasz Kubiak from the International Chamber of Commerce's Banking Commission, who has come in especially this week from Paris. And we're going to be getting into the details of a 108-year-old institution. Forgive me if my maths is bad, but Tomasz, first of all, welcome.
Thank you, Deepesh. I'm really happy to be here and glad to start this breakfast with you in Singapore.
Yeah, and it's quite weird because we're in a hotel and we can see real live birds watching over us and listening in on our podcast. So it really is a live recording.
Yeah, good omen for this very interesting week, I think.
There's a lot going on. Let's just start from the basics. And can you talk about what happened 108 years ago? I presume you weren't around when this happened.
No,
but,
I'm starting to get a few gray hairs, but I wasn't there around. Well, basically, right after the First World War, some enlightened and commerce-minded entrepreneurs got the idea of coming together from different countries and create the International Chamber of Commerce with the aim of being really the merchants of peace. Mm-hmm. That's how they call themselves at the time, and that's how we still remember today. And the idea is simple, is that bringing together businesses from all around the world, from different sectors, and really trying to come together, discuss together, and come up with ways to facilitate global trade. And so that's been the ethos of ICC. It has survived many turmoil of history, and it still does. And today it's considered the World Business Organization. And we're trying every day to make trade work and bring more opportunity for all actors around the world.
From the merchants of peace to the facilitators of global trade and commerce, what's the broad structure of the International Chamber of Commerce?
So ICC is an old organization now, but a quite complex one. ICC's headquarters are in Paris since the inception of ICC, but we have our members worldwide, which have affiliation to our national committees. I think we currently have close to 100 national committees. So you would have ICC Singapore, ICC France, ICC Mexico, ICC everywhere. And so our national committees, who have an independent structure and flexibility, provide us the members within headquarters, and that makes the ICC Global Banking Commission overall. So this addition of all those minds, all those experts for our banking commission in trade finance, that makes the banking commission. So overall, currently we have around 800 members covering different regions, but also different expertise, different focus, and that enables ICC to work. This is really on the policy aspect of things, but we also are a dispute resolution service with the ICC Court of Arbitration, also being more than 100 years old now, and trying to globally facilitate international trade.
Tomasz, I'm going to ask you a question that I haven't asked you to prepare for now.
Okay, go for it.
What's the juiciest dispute? You don't need to name names.
What's
the juiciest dispute that you've come across?
Oh. Well, I started working at ICC within the Court of Arbitration, so every case is confidential, so I wouldn't be able to really comment on that. But I think I wouldn't call them the disputes, but the heated debates that I came across were happening during the ICC official opinions review.
Uh-huh.
So this is one service that actually we do, and by we, ICC headquarters and national committees. So if you are a member of ICC national committee, you can ask, and you have a trade finance issue and question with a real life UCP 600, ISBP, ISDGP, URDG, whatever ICC rules you cover, you can ask your national committee to prepare an opinion that would be reviewed by our pool of experts and overall by the 800 members. And during those very technical and very expert debate, you wouldn't believe how trade finance impassioned people, and I wouldn't say they wouldn't go as far as yell at each other, but it's really like almost a gladiator fighting between who is right, who has the best interpretation of UCP 600, and the debate between the practicality of and the word of the rules are really the most. What was your question?
Juicy.
Yeah. So that's my example of how juicy those disputes were.
It's interesting, and you mentioned lots of letters, and some of our listeners might understand some of those terms. Some of them are possibly yet to come across some of those terms. But I often think about it, and please correct me if I'm not quite right. The ICC, the International Chamber of Commerce, has created many sets of guiding principles and rules that govern global trade. So the UCP, the Uniform Customs and Practice, and I'm not going to test myself on all of the acronyms, but they are essentially a set of rules, right, that govern the practice of how international commerce and international trade works, right?
Yeah. And we're talking again about history. The first UCP were created in the 1930s, which happened in a time where not only politically, but also economically, tensions were high, diversions were high, and yet ICC and trade finance experts at the time were able to come up with a set of rules. So by rules, I really mean Article 1, what is a letter of credit, because that's what we're talking about in the UCP. That's the thing, like Article 1, 2, 3, 4, 5, it's really like as simple as a code, basically. And that's a definition, a description, and a guidance for anyone who is involved at some point in trade finance, being from the bank side, being from the business side, being also from the innovative ways of doing trade. I'm thinking about paperless trade, digital trade, but all those rules are the backbone of trade finance. So that's really what ICC really do trade finance. It simply enables it to happen through those common rules. So if you're doing trade finance in one country or on the other side of the planet, the rules you follow are basically the same and you speak the same language.
So technical question, why do we need rules? Why can't we have legal infrastructure that countries can perhaps refer to? Why was the need to create these global rules by a body such as ICC?
The legal structure exists. Countries have commercial laws that obviously anyone needs to abide by. But then you go into a more detailed level of intricacies, really how the commercial law, the instruments doesn't describe how long it should be or how actors should really be behaving. And that's why the ICC rules are basically a subcategory of law. So it's not law, it's practices that private actors decide altogether to abide by. And what's the benefit of it really means that you'll get the same language, basically. You will know that if you're talking letter of credit, if you're talking standby LC, if you're talking guarantees, you'll get the interlocutor with its rule open at page, whatever, understanding the same as you. And if it doesn't, then it can be settled through dispute resolution, being by the ICC opinions, being by the DocDex procedure as well. So it's going beyond law in a level of detail that is required by businesses which are doing global trade, which involves sometimes thousands, if not millions dollars contracts, and want to make sure that the contract is going to be fulfilled and happen the way it was intended to happen. So it has huge implications. The ICC rule streamlines that in the end.
And I'm sure we could be here for days if we went through the breadth and variety of rules, but there are those guiding principles and rules for many areas of trade, like shipping rules or international commercial terms, as you mentioned, the letter of credit or UCP or demand guarantee rules. But let's deep dive into the ICC Banking Commission today. And here we are this week in Singapore, and there's quite a lot going on. And I guess the reason why we wanted to speak to you is to get a bit of an update and a bit of a flavour of what's coming out of Paris and what some of the recent activities of the Banking Commission are. So I'm going to ask three themes. So first of all, I want to talk about the elephant in the room, that is sustainability. And I know there's quite a lot coming out of the Sustainable Trade Finance Principles. Then we're going to talk about the trade register, and then it would be good to have a bit of a regulatory update. But starting on the Sustainable Trade Finance Principles, and we've written about all sorts of weird and wonderful things like Wave 1, Wave 2. In layman's term, why do we need principles framework for sustainable trade finance? And what was ICC's stance on this?
So in the end, we started discussing what is ICC's ethos, why do we have ICC banking rules? And my answer has been harmonization, standardization. That's been the case for the past 108 years. And the members think that it also applies to something as important as sustainability. Either we following the international debate on sustainability, science will tell you it goes one way, you will have numbers, you will have global warming, but in the end, for practical trade, for innovation as well, and therefore for the instruments that facilitate those kind of innovation, you need an even playing field at some point. Not necessarily very iron-fenced rules, but in the case of our ICC Principle for Sustainable Trade Finance, the member thought that having something similar to what the LMA Green Bond Principles have was necessary. So that's why for the past now 4 years, I think, we worked with them on creating those kind of harmonizations, if not to talk about standardization, because perhaps we're not at this level of maturity in this field.
Yeah.
But basically having an even playing field in some ways in how we define the matter, how also the trade cycle is defined. And that's a big difference, for example, when it comes to green bonds against green trade finance, is that obviously the instruments are different and the life cycle of trade is sometimes a bit more complicated. So that's why also we worked in waves to make sure that we were delivering the right message, the right time, the right metrics. And that's why last June we were able to announce that our first 4 members officially endorsing those principles. So essentially that means that they recognize those principles as workable, as practical, and make sure that from one bank to another, the level of understanding is, if not identical, at least very similar. So we're not comparing pears and apples.
Yeah. And those 4 banks, Commerce Bank, ING, Standard Chartered, represent 25% of global trade, or rather it's estimated on that by volume. But they've endorsed the rules. Do they use the rules? Have they implemented those rules themselves?
They endorsed the rules, but they also created the rules with us. Not only those 4, it's not exclusive, but that's how ICC rules. It goes for the UCP, for the ISBP, for all the rules. They are in the end agreed by the overall trade finance community. And for the ICC PSTF, it was a big working group of not only banks actually, because it's important to mention the ICC Banking Commission and the ICC Environment and Energy Commission working together on this. It's not solely a banking matter. And so we gathered more than 200 members overall, with obviously a big participation, as always, from the ICC Banking Commission members. But to make sure that we didn't only capture a partial vision, a happy few vision, but a kind of common ground. And so those 4 banks are the first one ready to jump and announce publicly that they abide by those rules internally. But doesn't mean that the banks that didn't yet endorse it do not. And also, practically speaking, internally, I'm not necessarily working with them, but there's a few adjustments to be made to make sure that they're abiding by. But that's the work in progress we're doing. So with them, and also with the banks that didn't yet endorse, but I'm hoping we'll soon jump from the private working group, closed door working group, ICC working group, to the public announcement very soon.
So it's all about making these rules practical because there are lots of principles and guidelines for sustainable finance. And you mentioned the LMA kind of sustainable bonds framework, the multilateral development banks. I think IFC and Asian Development Bank have also issued reference notes with regards to sustainable trade finance. How do we prevent a problem where a small bank in an emerging market with limited resource probably doesn't have the capacity to implement lots of different types of sustainable trade finance principles, and actually they're practical to implement? Because another thing is when you look at perhaps an energy project or a 20-year export finance project, is very different, and you can probably take some time to do the paperwork. But some of these transactions, short-term, self-liquidating, 30-day facility, deal needs to go out in 48 hours. So how do you quickly ensure that it falls under this sustainable trade finance framework?
That's an excellent question. I think you touched the point that the working group worked on for the past 4 years, is how do we make those principles workable and not being just like a declaration of intention, which has no implication, but also how do you make it not too constraining and also practical? And that's a bit what the principles are trying to do. So it describes very robustly the cycle, who are involved, what do you measure, what are the requirements, what are the minimum safeguards. So it's not like you do whatever you want. There's still logic, a methodology that any bank and business abides by. But then there's a flexibility in the practicality. How do you implement it within your organization? The principles can be implemented in a global international bank, as well as in a regional smaller one that you just described. And the logistic to put them in place are not necessarily too burdensome, but the methodology is, we think, robust enough not to be regarded as a box ticking exercise. And in the end, when we drafted the different waves and when we had those different working group sessions where every now and then, when we would create the architecture of the principles, we come up with an example. Let's say, oh, it's an LC from this country to this one, like a steel shipping. How does it work concretely? And so we would come up with the idea of how to concretely, what to be careful of, to be really robust. And then we'll get, oh yeah, but what if it's, and we will come up with the craziest scenario sometimes just to test the whole system. And just to come up with what you mentioned about it would work for different rules, for different products. And in the end, we didn't test the millions, if not billions of possibilities that it could have. But we think that it captures overall the global way of how trade finance work. And while still being practically implementable for banks, but also for the businesses that are going to benefit from the trade finance.
Great.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Let's take a quick break from those updates. And I want to talk about the next generation of trade finances, because I know it's something that's close to you personally, Tomasz. Because I think I've heard 2 times this week, and I don't really think the week's even started, that people are retiring from this industry. And you mentioned those juicy stories, the trade finance stories, the practicalities of those rules. I don't see many young people getting that engaged. So do you think the ICC has a role to inspire that next generation? Well, first of all, is there a problem?
So I wouldn't say there's a problem, but we need to engage the young generation. Yes, since I joined the Banking Commission as secretary in December 2019, I've always heard about the trade finance experts are retiring. The new generation needs to be involved, but the industry interesting enough for the young people. I think there are opportunities for younger, more diverse generations, but they need to first know that the ICC Banking Commission is open to them. And that's a learning curve. You first join, let's say, your business or your bank, and you learn about what trade finance instruments are, how do they work concretely, and then step by step, you understand that you have this industry-wide representation that is ICC, and specifically for trade finance for the Banking Commission. There is this learning curve. And I think in this sense, it's for the one that knows about the rules, that sometimes contributed to its drafting, to take and convince those younger colleagues that the Banking Commission is open to them. And so the message is clearly, it is open to you. So your national committee would be interested in having you in its commission, in its working groups, and the global one as well. But how do you make trade finance interested for younger generation? I think there's also the message that trade finance is changing, just like global trade is changing, just like the world currently is changing. But there are opportunities for new debates, like we just discussed sustainability, but I'm thinking obviously about digitalization, the move out of paper-based trade finance is a fascinating one. And I consider myself also the younger generation.
Well, you haven't got a single grey hair, so...
Yeah, not yet, but maybe the discussion within the Banking Commission on Thursday would make those grey hair pops. We'll see.
Absolutely not. Let's talk about the ICC Trade Register. Yeah. Tomasz, in one sentence, what problem does the Trade Register solve for banks and regulators in 2025 that it didn't perhaps a decade or so ago?
Well, the easy answer is that today we have 15 years back of data that shows that trade finance, no matter what happened in the past 15 years, is very resilient. Trade finance defaults are historically low. Product by product, you'll have different variations, but overall, it's a very low-risk industry. It's based on its nature, the fact that you are working, really trade finance work for facilitating the real economy. So you have contingency, it's based on everyday global trade. And so this is perhaps self-explanatory. You don't necessarily need the 15 years of data for that. But then you need looping in and a focus that the trade register really provides. And that's in an era where everything, we're talking about data being the new gold. We need data for everything. We need insights to make business decisions. So does trade finance. And that's what really the trade register does. And 15 years ago, it was true when WTO DG Pascal Lamy suggested the name ICC Trade Register. It was true, and it's certainly true today. But now we have really 15 years of undisputed data to back that, and that it is being used every day by the banks that tirelessly work on providing the data for the yearly register, as well as the regulators. It's really the most powerful item we are putting at regulators' eyes.
For my mother, what does the exposure-weighted loss-given default rate of 0.1% for import LCs and 0.02% for export LCs actually, what does that mean in layman's terms? And perhaps if you can maybe compare that to other classes, is it a similar percentage? And finally, so what? Who cares?
Wow. Okay. Putting this way, it's more complicated actually than anticipated. But basically that means that when two companies have a contract with each other, they don't trust each other, they use trade finance instruments in 0.01% or 0.001% of times, the bank providing the instrument would actually not fulfill its obligation. So that means that 99.98% of the time, the instrument fulfill its purpose.
Which is pretty good,
Which
right?
is pretty good. If you take the mortgage rates overall, those rates are much higher. I don't have the numbers in mind, but I've always been told that they are much higher. Those numbers would make envy for any other industry or any other solutions. Or
according to a lovely friend, Google, the US delinquency rate for residential mortgages was high as 1.79% in the first half of the year. What are we doing with the trade register data, and why do we need to tell a story or this story to the regulator?
So the trade register is, to my view, a success because of those 15 years back of data, but it's a partial success because we need more banks to provide their data into this global pool. We currently have 22 or 23 member banks, and the caveat we have is that regulators are telling us that's great. We understand the data, the methodology is very robust. It's aligned with the Basel principles. It's across instruments. It's very clear, but you don't represent all of trade finance. And so it's a fair assessment.
I was going to say the same thing.
Yeah, no, it's fair. And the power of the trade register is that it allows us to have this conversation in the first place with the regulators. And then their counter-argument is that it's lacking some important actors. And that's why we are working on that. We are lucky to have a new chair of the trade register, Samuel John Matthew from Standard Chartered. And we're trying to expand that with our partners from BCG and Global Credit Data and our current members to find ways of attracting more banks into the register to grow basically this pool to end up closing the question marks that the regulators have about the representativity. And so that's why the call for action is clear. And it's been shouted by our current chair of the Banking Commission, Florian Witt, from ODO BHF, that more banks need to join the traders. I'll just quote him from a previous Banking Commission meeting. He said that the maintenance fee for joining the report, it's basically 1.5 letter of credit.
What's that fee?
15,000 euros currently.
Okay.
So it might be a bit provocative, but in some ways that's true. And it's not only allowing us to get regulatory bodies here, but also banks can leverage really on the level of insights that the register has when it's the analysis per instrument, per region, if it's the loss given default analysis being done, the level of intelligence that banks can get from the register is much more attractive than simply stopping at the maintenance fee, which I understand can be important, especially for regional and smaller banks. And that's why we're trying to find ways to get around that. And that's why we are discussing also with MDBs to find constructive ways to engage with them and their partner banks to allow growing the pool of data of the trade register.
Thank you very much. You heard that here first on TTP. Before we go into the nuances of the Basel regulation, which is the final kind of key point I want to go to our listeners, it's definitely worth tuning into our series with ICC Austria's Trade Finance Week, where we caught up with Krishnan Ramadurai, CEO of Global Credit Data, who goes into the detail on these loss given default rates and why they matter a bit more. Another quick break, because Tomasz, you're running a marathon in a few months' time. What are your top tips for training for a marathon?
Hydration. Hydration is the top advice I would give myself. And trusting the process and trusting your program. That goes for marathon running. It goes also for trade finance, trusting the process that ICC put in place, trusting the ICC banking rules, and trusting your running plan. So we'll see if I stick to it. Physically, I stick to it, but mentally, I'm already at the finish line.
Can't wait to hear how you do. Back to Basel 3.1, something that's very close to a lot of people's hearts in the trade finance community. Why is it important? What's the latest? Can you give us a bit of a lay of the land?
We're coming at the end of the process. The different regulatory bodies are issuing their final statement, and we see the end of the legal procedure. And you'll have the members, and you discussed it with Krishnan earlier, so they would be more experts than I am on really the technical consequences. But from the initial feeling that we have gathered from the members, the idea is more or less of a status quo. Mm-hmm. There was fears really since the beginning of the different processes, which were partially answered thanks to the push either by our national committees directly to their regulators or directly by the ICC Global Banking Commission to make sure the regulatory treatment wouldn't put trade finance as a scapegoat. And by possibly lack or misconception of what trade finance really is, overburden an industry which would benefit from more capital relief than more constraints, as the trade register showed for the past 15 years. What is important for our members, and that's the message that we've given the regulatory body, is that trying to clarify what trade finance really is to avoid misunderstanding of what really it isn't. First, that it's a financial service facilitating the real economy, enabling business to finance, monetize, and risk mitigate and settle trade finance flow. That it supports the movement of good and performance of services, and that it is the case regardless really of maturity internationally and domestically. So that's perhaps the first time during our discussion that I took the time to read the ICC definition of trade finance. And this is something that we've done because we realized that there was a gap in this and we needed to clarify that as an industry. This is a simple 2-sentence definition.
It's important
that embodies what trade finance is. And that was really our message. And this is still our message because we mentioned that Basel 3.1 is coming to a close, but we're not yet at the finish line, and to come back to the marathon metaphor. And what is really important is to bring a better awareness of what are the consequences for a business, for a huge infrastructure company, if its CCF on performance guarantees is not of 20%, but of 50%. The implications are simply enormous. And so that's the message that we managed to pass, especially for this example, for the EU regulatory, but it applies also for other jurisdictions. And so this is the still ongoing work and educational work we need to continue. And it's important to remember that beyond Basel 3.1, the journey is not over. It's a continuous, I would say, advocacy, but more awareness path of what really concretely is trade finance. And so that's why we came up with this definition of trade finance, to make sure that it stick to the regulators' ears and in the end simplify the everyday work of our members.
Are you satisfied with the outcome in terms of the current implementation of Basel 3.1, or is there still a bit of a journey to go on?
I think overall, the fact that we're able to discuss it is a good sign. The fact that there's an open conversation, jurisdiction by jurisdiction, that our national committees are fully committed also to deliver this message. And from what we see, for example, from the European Banking Authority and its release of the regulatory technical standards last month, that we can live with the interpretation they had, but it is not entirely satisfying, and that's why we need to continue this discussion. In some ways, it's not necessarily ideal, but it's fine.
Yeah, it's super nuanced and it's being handled jurisdiction by jurisdiction, and it's having many impacts. We need to think about everything from the credit conversion factor to leveling the playing field, and also not just the low risk self-liquidating nature of trade finance, but the fact that trade finance by nature is cross-border, therefore poses probably potential complications. Final question, where do you think the ICC will push hardest in the next few months? We've discussed the trade register participation, embedding, endorsing and implementing some of those sustainable trade finance principles, or continuing on in terms of advocacy or on prudential calibrations. What are you going to judge yourself on in terms of judging success over the next few months, Tomasz?
Definitely, if we have more endorsements for the ICC principles, for sustainable trade finance, definitely if we have more members in the trade register, but also if we have a deeper level of engagement also on the fight, if I can say, against paper-based trade finance. So moving from paper to digital, if we continue not only to push, but also trying to innovate or trying to come together with the whole trade finance ecosystem on simple ways to move from paper to digital. And the level of engagement from our members at national committee level, pushing us to do more, is a way to show that ICC Banking Commission is the door to knock to get things changed, to get more engagement also on the compliance, on fighting financial crime and risk, on export finance, on supply chain finance within our Global Supply Chain Finance Forum that is not only an ICC initiative, but also a VAFT, ITFA, FCI, and EBA initiative, and leaning towards that also increasing level of cooperation with other industry associations, with multilateral development banks, with having a voice at international fora, at UN level, reminding people that ICC holds the observer status at the UN and are using this voice for bringing trade finance topic at the table. So those are the kind of metrics of success that we will be abiding by.
It's 10 o'clock. I guess that's breakfast closed. But I guess from an ICC Banking Commission perspective, I'd probably say there are 6 things that the Banking Commission is open for. Emerging leaders and young professionals coming into the industry, a push towards sustainable trade finance principles, encouraging partnership with other bodies, multilaterals and associations, moving forwards with that pragmatic implementation of the latest round of Basel reform and rules, removing the paper from global trade and providing better good quality data on trade finance. Tomasz, thank you very much for joining us on Trade Treasury Payments here in Singapore. Enjoy the rest of your week.
Thank you, Dipesh. Thank you all.
And don't forget to follow Trade Treasury Payments
On your favorite podcast platform.
Thanks for listening.